Hi everyone, thought I might just do a bit more information about accounts receivable and accounts payable, just because it seems to be a bit of still a tricky spot. So basically accounts receivable is when you're selling a product, you send out an invoice today for the product, but it's a later date in which you receive payment. So there's two transactions. Accounts payable is when you get a product, you get the product immediately, you've got an invoice, but then at a later date you then pay for that invoice. So that's called accrual accounting. So you've got two versions. You've got like types of accounting. Hopefully you've gone through this in your textbook already, but you can do your books on cash or accrual accounting, and accrual accounting is basically recognizing the income straight away. I'm going to quickly go through first accounts receivable for Tyler. So as I mentioned it before, accounts receivable is when you are selling a product, the customer is getting it, but there's a delay between giving out the product or the service and receiving the money. So that's when we've got kind of your two transactions going on, one for when the product or goods and service goes out, or the other one where the money comes in. So your first step is recording the sale. So accounts receivable is debited, then sales is credited. That basically just records that, you've got the money coming in, and accounts receivable is an asset in the balance sheet. So we know that this is a good thing. It's money coming in the future. So it's a good thing, it's an asset. Whereas in accounts payable, that's a liability because it's money coming out. And accounts receivables and accounts payables are classified as current, so current asset or current liability. Okay, hopefully that makes sense. A moment, I'm going to turn on my air conditioning. Okay, getting a bit hot in Brisbane. Okay, so that's our first step, is we've got accounts receivable, then the sales. And then if that sales is just a broad term. It depends what you're selling. If you're selling a service, then it's easy. You don't need to do another transaction. But if it is a product, like my air conditioning remote, which is very old, you then also do another journal entry. So then your first transaction, so remember your first period, will go accounts receivable is debited, sales is credited, then your cost of goods sold is credited, and then inventory is debited. So this basically increases on the P&L, the cost of goods sold as an expense. So your revenue go up, and so will your cost of goods sold. So then you'll have your gross profit. There's a good website I'm actually looking off right now. I'll put it in the notes below. That will help you. It's pretty simple. It explains it really well. So that's all you need to do for when the transaction actually happens. The very first one, when the goods go out of your store, and you're going to get money back in, you just don't know the exact time. Most companies do like a 30-day payment term, or 2 weeks, but most do 30-day. And then, so I'm not sure if you guys have covered allowance for doubtful debts. I'll go over this briefly just in case it does come up in the future weeks. If I'm selling this remote for $100, this is going to sit in it as accounts receivable in my balance sheet for $100. Now, let's say 15 days down the track, someone said, oh, by the way, I think whoever purchased this isn't going to pay for it. So all of a sudden, we don't think we're going to get the money back for this. So then we go into like provision for doubtful debts. So it's in this link I'm going to share below, but basically what we do is we can then create a set of journal entries that if we're worried that we're not going to get the money back, we can create a bad debt expense and allowance for doubtful debts. I don't want to talk about it too much because I don't want to confuse everyone, but you can see it. Basically, all this means is that if we think something's going to go wrong, we're not going to collect our money in our accounts receivable, we can then we can create a provision for doubtful debts. And then it's also got it here in this website. If it does occur, we are not going to get some of our money. It's got the journal entry of how to record that. So I'm not sure I don't think you've been taught it in week 2, but just a heads up for future stuff. I'm not sure if the unit covers that off, but it's good to know. But I don't want to get into too much detail because it will confuse you. So if we just go back to the first step, so the goods have gone out the door, the services have been conducted, it's done. Its accounts receivable is debited and the sales is credited. If it is goods, then then we also do cost of goods sold, debited, inventory credited. Okay, and then the day the payment is made back to us, so that this is when we're actually getting the cash in, we go debit cash, so that's increasing the cash, which is increasing your asset account, and then crediting the accounts receivable, so that's decreasing the accounts receivable. So basically you're clearing out accounts receivable and putting it into cash, so it's still sitting in the asset, in the balance sheet. The asset position doesn't change. Okay, hopefully that makes sense. Your P&L, the income recorded, is recorded in your first part of the transaction. That's showing your P&L. So if accrual accounting, you're recognizing it straight away, day one, that the goods or services go out. And then the balance sheet will show the same amount of asset. It's just flipping from accounts receivable to cash. Hopefully that makes sense. Cash is also a current asset. So if you know how to determine what's current and non-current, it's basically we look at the lifeline of whatever the account is, so whether or not it'll last more than 12 months. If it's more than 12 months, it's a non-current asset. Less than 12 months, it's a current asset. Same with liabilities. Okay, so hopefully that kind of makes sense with the accounts receivable. Again, don't stress too much about the bad debt side of things. When we do come across it, if we do, I'm not too sure, I can't remember, then I'll go into more detail, but it's good to know, especially if you are majoring in accounting or finance. It's good to know that, or financial planning. But yeah, this website, it's just accountingtools.com. It's got a really good overview. So I'll post the links below. Hopefully that will help. And then I'll quickly go into accounts payable. I haven't found my correct website. I will, but it's in there. So accounts payable is when we are purchasing something on credit. So maybe purchasing a water bottle. So I need to buy water bottles. I'm a business, I sell water bottles, so I'm buying it from my manufacturer. So today I get all my water bottles delivered, but I actually don't pay anything right now. It's a 30-day term, so then in 30 days I pay it. So this is exactly the same as accounts receivable. It's just flipped. So the transaction, the day I receive my water bottles, you first debit your goods, or if it's a service, so I'll debit inventory or water bottles, whatever the account is called. And then I will credit accounts payable. So this is a liability sitting in the balance sheet. So we've got that there. Then when we pay the invoice, so this is say 30 days down the track, I'm like, yep, all right, I'll pay. Now, most companies choose to pay at the end of the payment terms for cash flows, and cash flows we're getting to. So cash flow is important to track our money. This is like future, looking into the future. So we manage cash to make sure that we can meet all our debts, all right? And accounts payable is a debt, so we have to pay it. So in the future, our transaction is we debit accounts payable, then credit cash, because we're using cash to pay off the accounts payable. So your cash goes down because you were crediting it, and then debiting accounts payable, which is the liability, it will clear it out. Okay? So hopefully that makes a lot more sense. I will find some good resources. I'll put that accounting tools website, which breaks it down really well. Hopefully that helps you understand it a bit more. It's really not that hard. It's like you have a cash transaction. It's just, you know, two things exchanging, cash and a product or a service, one transaction. Accounts payable, accounts receivable. It's the pretty much the exact same thing, but we've just got two, and we've got an I can't say the word, intermediary, whatever, in between that. So we kind of, instead of going straight from product to cash or service to cash, we go product, accounts receivable, accounts payable, and then to get the cash. So it's a bit more of a triangle than a straight line, if that helps. Anyway, if you have any more questions on this, just post below. Tomorrow I'll be introducing a bit more onto week 3. I might do a video maybe tomorrow on some of the content. Remember, if you're watching this and you haven't done your group thing, if there's someone you want to be in your group, go over into the discussion for the report and create a group. Otherwise, I'm just doing it for you at the end of week 3. All right, see you, bye.